Mark, where are we going with the dollar? There does seem to have been this period in which the dollar confounded so many, started to reverse now a little bit. Does that stick?
Yeah, I think the next move is lower, and I think that's clear for April. I think what we're trying to figure out here is I think what markets have tried to do is extrapolate two themes that are blending together. And 2020 was all about the so-called global reflation trade, and 2021 has been all about U.S. exceptionalism. I do think that what we've seen is markets try to extrapolate extreme points from each of those narratives. So starting the year, I think the market was wrong in the dollar because it tried to extrapolate global reflation and missed the signs that were coming through that the U.S. economy was doing much better than expected. But I feel like we're making the same mistake now, which is essentially extrapolating U.S. exceptionalism. You can't have an exceptional dollar with the Fed basically working with a new policy mix as it relates to average inflation targeting. And I think that's a big view that we have here, is that we've gotten really good data. We've got, strength of the U.S. recovery, but we've got the Fed who's basically saying we're not going to move rates on that. We're going to let the economy run hot. And that's a backdrop of an improving global economy. And as Fed on the sidelines, it's not great for the dollar right now.
So from that perspective, what's leading what? I mean, is the Fed leading the dollar, leading yields, or is it yields reflecting that Fed story that then leads the dollar?
I think it's a great question, because I think it's the yield move was a validation of the pickup in the global economy. And what we didn't see in late 2020 was a validation that the global economy was rebounding. And our models have showed that non-U.S. global growth expectations have risen quite substantially in Q1, just not at the pace of the U.S. So the sell-off in bond yields was a validation that the global economy was moving in a right direction, which fits into the vaccine trade, which is basically, it's a global phenomenon. The U.S. had basically advanced faster than other major economies, along with the U.K. And now, Q2 and Q3 is really about the catch-up trade, because this is a global expansion. It's a cyclical recovery. You talked about commodities as well. And so all these factors are playing together. And so, a big part of it is that move in rates was not just a U.S. move in Q1. If you look at EM yields, if you look at EM central banks, they were much more hawkish than expected, largely because, again, what we kind of need here is a validation that the global economy is moving in the right direction. So yields are moved to essentially rise what was going on in the global economy, but now they've backed off a little bit because they priced in what they needed to.
Do you think the global economy is looking good? I want to come back to this theme of U.S. exceptionalism. You look at what's happening in India, it doesn't look good. There's headlines out right now about what's happening in Russia. The EMA also out with details confirming a causal link in terms of what is happening with the J&J vaccine. J&J vaccine, rare clotting, causal link possible. That's a key word that needs emphasizing. The U.S. is miles ahead. If the J&J vaccine is not part of the mix, the numbers still look fairly good. Is there a possibility that we go back to actually the rest of the world not looking so clever and the U.S. continuing to drive ahead in terms of what it's seeing in the reopening trade?
Well, I think that'll be challenging, because the offset to the U.S. story will be the recovery in Europe, and also what we've seen is the strength of the Chinese economy. The data that came out of China recently was really quite solid. And if you look at kind of China as a function of driving commodities and driving, a global growth factor, it's doing quite well on that regard. So I think a big part of it is J&J is a big part of maybe the North American vaccine portfolio. But if we think about what's happening in Europe, there's the numbers are moving extremely in the right direction in terms of the vaccines. And so when we think about Q2, it's really, I think a big concern with J&J is it works within the U.S. vaccine portfolio. And so part of what we'll see in Q2 is a pickup in a convergence of what we're seeing across Europe as we look at U.S. and European growth dynamics. So I think a big part of it is, again, Asia looks quite solid. If you look at Korea, if you look at Singapore, if you look at China, you look at Taiwan, Australia, New Zealand, those countries are doing quite well. Again, India is struggling. There's definitely struggles that are coming through in Latin America. You look at Brazil as well. Chile's actually struggled, even though they've had good vaccine numbers. But if you look at like the big driving forces outside the U.S., particularly Europe and Asia, there is a convergence trade that's coming through here, which is driven by demand coming from those economies.
So what's your favorite way to play that then?
Yeah, it's a great question, because it's challenging. So what we're saying is, dollars lower, particularly against some emerging markets. Again, a lot of it would be focused in Asia. Some of it, you do see some value in Latin America. I think Chile's an interesting one. So if you like the China story, you like the global growth story, you like the copper story, then Chile's likely to benefit from that. I think in Europe, it's actually quite interesting because I think the divergence trade is in Europe. And if you want to play the pickup trade, where we've pushed back on the euro narrative, is instead of buying euro dollar, you should be buying euro sterling. And I think that's a much better way to play the vaccine and the growth convergence. I think a big thing that we've seen is that if you look at the mobility data, which tells us what's happening real time, it is quite alarming how high the U.S. Mobility numbers have gone. They're at record highs. We see the exact opposite in the U.K. is while there's a lot of anecdotes around the U.K. reopening and the economy doing well, the mobility numbers are actually very, very low. They're actually one of the lowest in the world. So I do see, like, if you want to play the European convergence, it's buying euro sterling. It's selling Norway versus Sweden. Sweden would benefit right now from the pickup in European growth, where Norway benefits from kind of the global economy doing better than Europe. And I think another way to kind of play this as well is selling sterling versus Swiss, which is another kind of European trade with, again, kind of fading the recovery in the UK and also thinking about the upcoming event risk in Scotland.
You turned negative on the CAD and the NOK. Less bullish on the CAD and the NOK. Let's just talk a little bit about the commodity story and the commodity currencies. If China is doing well, if the global economy is reflating, I'm presuming that oil prices are going to pick up, and we're certainly seeing evidence of that. Alix was pointing out what's happening with copper at the top of the show. Walk me through the case around some of these commodity currencies.
Yeah, I think the key part is, one, how much of it is priced in. So again, a lot of that reflection of CAD in Norway is really for the month of April. We run different risk premium models to tell us whether or not there's too much excessive optimism priced in. Norway and Canada, I think, are those two stories where, at least for this month of April, I would rather underweight those versus other currencies. So, if you want to think about the CAD story, I think buying the New Zealand dollar versus the Canadian dollar is a much better play, especially as we go into the Bank of Canada. And Norway is another one where Norway would do quite well as a global economy is advancing. But the question is how much news is priced in. The Norges Bank is well priced in now. The oil story is priced in, and Norway's trading at about a 2% risk premium on our medium-term valuation model. So I think a part of it is, if you want to buy the commodity story, Chile is a prime example. Another one is Colombia. It's an energy producer. It kind of gives you the same characteristics of CAD. I think one of the big things that we drive is that the Canadian dollar is really not an oil currency. It's correlated to risk sentiment, and oil just happens to be correlated to risk sentiment as well. But yeah, I think what we're trying to do is find divergences of where things have moved too far in one direction and find ways to trade those in the very short run. But I do think Norway is going to be a good story over the medium term, the next 3 to 6 months, along with the Canadian dollar, along with the Australian dollar, along with some of these other commodity producers.